In this video, I want to share with you my M1 Finance portfolio. One of the most prolific investors in the world is Warren Buffett. And Warren Buffett says he's got two rules, actually. The first rule is don't lose any money. And the second rule is always follow rule number one. And one of the things that he recommends is this, especially for beginning investors or people who are really interested in developing kind of a long-term strategy, is to pick a good index fund and then just invest in it with regularity. And so in this video, I'm going to share with you the index funds that I've chosen. My M1 Finance account is where I've kind of chosen to use this strategy, my index fund strategy, my ETF strategies. So I'm going to share with you my M1 Finance account and some of the things that I'm invested in and why. So without further ado, let's get started. My name is Paris Clough, and this is Financial Self-Reliance. I absolutely love helping people manage, protect, and grow their money. And in this video, I'm going to share with you one of the ways that I use to grow my wealth in indexed fund investing and ETF investing. Index investing and fund investing is probably one of the easiest ways to kind of get your money, put it into this investment, and then just let it go. Typically, index funds, 80% or so of money managers can't beat the standard index funds. And so a lot of people out there are like, well, I've got to get a better return. If you just pick an index fund, you're probably going to be way better than 80% of the money managers out there. Not to say that there's nothing to picking some individual stocks that you might really like to enjoy or like to own, but I think it's important when you're investing, especially when you're getting started, learning the market, learning how the stock market works, is to just pick a good, strong index fund like the S&P 500 that's solid, strong, and been around for a long time, because you're going to get great results. So let's jump right into my M1 Finance account. So this is my M1 Finance portfolio. In this portfolio, I put $100 a week into it, and it's grown to $15,676. What's interesting is that I'm actually at minus $4,000, so I'm at a 31% loss in this account. I should have closer to $21,000 in here based on how much money I've actually put in, but the market's been horrible the last several weeks and months. And so hopefully I'll see this return. I continue to buy into the market though every week, doing something called dollar cost averaging. And I have a video that I'll link up here that I've done about dollar cost averaging and understanding why it's important to calculate your average share cost and average share price. So as the market goes up and down, you're continuing to invest. And so when it's down and you're investing, you're buying more shares of that stock so that when the shares come back, and hopefully they come back, when those shares come back, you're hopefully going to have that value now at much higher levels. So you're going to have more shares at the higher value than you would have had the market not dipped down. So I'm still investing every week into this fund because this is my long term. This is what a lot of people in the FIRE community, which is financial independence, retire early, what they'll call their financial independence number. And what you do to determine your financial independence number is you basically take 25 times your annual income, or what you need to live today, times 25, and then that's your goal. And then you set a course to obtain that goal, and that's called your FIRE number, or your financial independence number. So for example, if you live on $50,000 a year, 25 times 50 is about 1.2 million. So you're going to need that amount of money saved up somewhere to be able to have that interest pay you. And that's the idea, is that when you build up a portfolio large enough that the interest continues to pay your bills for you, or your money does your work for you, your money pays your bills for you, and that you don't have to work anymore. That's where you can have real financial independence, where you have enough money that the interest itself or the growth on that account, on that money, is sufficient to pay all your bills every year, and then you don't have to worry about working. Or what you would probably do is actually go do something and find a life or work that is more fulfilling. And that's probably where I would recommend most people go, is do something that's more fulfilling to you. To quit working is actually not a part of human nature. It's in our nature to work and to strive and to do good things. So in the M1 Finance portfolio, M1 Finance does what are called shares or pies. This is a pie. My whole portfolio is considered a pie. And then each one of these pies breaks down into another pie. But this whole pie right here has 1, 2, 3, 4, 5, 6 slices. So here's the slices over here, my indexes. So this is all of my index funds. So when I click on this button here, it tells me the index funds that I'm invested in, which is VTI, VOO, VXUS, and QQQ, which is the NASDAQ basically. So I have 40% in this one, 40% in this one, 10% going towards VXUS, and 10% going to QQQ. If I have all of these, I basically have the world that I have ownership in. So this is the Vanguard Total Stock Market, Vanguard S&P 500, and this is the Vanguard Total International. And then this is, of course, the NASDAQ. So there's some analysts that are saying that this VXUS is probably not that good. And so I may end up removing it, but at the same time, I've heard a lot of good things. And most people who are investing their money into indexes are choosing either VTI or VOO, with VOO probably coming in first place on all the indexes that are out there. So if you want to choose one of these two, I would highly recommend VOO over VTI, but I chose both just to have a little bit of exposure there to both of those. And I may change that up as time goes on as I consider my options. So you come back here to my portfolio and look into these. This is all my dividend ETFs. So, but an ETF is an exchange traded fund, and ETFs will invest in multiple stocks, kind of like a mutual fund, but it's traded more quickly and more fast. They have a lot more flexibility, and so it diversifies for you. And so you don't have to pick a bunch of stocks. You pick the fund or the ETF, and then they pick the stocks for you, and then that gives you that diversity that you really need and ought to have. And these are ETFs where I have all of it is just paying fantastic dividends. So I receive a lot of dividends. So once I jump into the dividend slice, it becomes its own pie now. This is kind of like a sub pie, and these are sub slices of my whole overall portfolio. And you can see I have these ones listed here, and these are all paying a dividend. And the good news with this one is that these are all green. I don't know if you saw the last one, but it was red, the last one. So this is I've made some good investments, I feel like, in my dividend pie, because it's all green, and it's a 1.28% return on my money in that fund. The indexes, I've lost almost 10.5%. This is my REIT fund. So all my REITs, which are real estate investment trusts, these are my ETFs that are invested in stocks that are purchasing real estate and doing work with real estate, whether it's commercial real estate, residential real estate. So if you want to get into the residential market or residential investing, and you're not really quite ready yet to be a landlord, REITs, or real estate investment trusts, are a great way to get involved in the real estate market, at least in that sector, to start building your portfolio and creating some wealth in that. Right now, as you can see, it's negative 24 in this one and negative 4 in this one. So yeah, the REIT market isn't doing very well right now. But I'm buying more as I continue to invest. I buy more shares at that lower price, which is one of the great news things about dollar cost averaging. So I have dividend ETF, dividend indexes, REITs. Now I get into my individual stocks. So I kind of wanted to create my own fund. What I do is I have Webull for my dividend investing, and that's where I buy whole shares. And that's where I kind of buy if I can get to 100 really quickly so that I can do covered calls or cash secured puts, then I'll do that on my Webull account. M1 Finance doesn't allow for options, and so I can't do covered calls or cash secured puts in M1 Finance. So all of the positions that I have in M1 Finance are all of the stocks that are much higher price per share, that are the solid, strong ones, like Snap-on, for example. They're at $233 per share. So I know that I'm not going to really anytime soon anyways get 100 shares of that to be able to do cash secured puts. And so with this particular one, I put it in my M1 Finance account because I can buy fractional shares, and I can still own. See, I own 0.42965 of Snap-on, and they have a 2.4 dividend yield. They're a really good company. They've been doing great things. And so this is where I keep my dividend stocks that I want to have that are much higher price, or I don't really want to build towards 100 to do cash secured puts and covered calls on. So I put them over here in my M1 Finance account. The other one I did or have is my growth stocks. These are just stocks that I really want to have a hope that they're going to be growth oriented. They don't pay a dividend. Like I have a lot of, as you can see, 19% of this particular pie. The slice that I have here of Tesla is 19% of this pie, because I want to really know that Tesla, and believe that Tesla is going to grow and have some great results. And so I actually own 1.62973 shares of Tesla. So that's pretty cool. They're $180, $186 a share right now. Before they split, they were $800, $900, $1,000 a share. So hopefully they might climb back up to that, and we'll see. And that'll be good growth. Some of these other ones are just ones that I like and support and think are good, that are interesting to me. So before you add any stock or anything ETFs to your own portfolio, do some homework, do some research, make sure that you're adding stocks that you are comfortable with and buying. Make sure that you're adding stocks and positions that you've done some research on. And so now I have ARK ETFs. They were doing fantastic for the longest time, and then they've just done horrible. So instead of selling them all off, which I really kind of want to do, but I've lost so much money, I kind of want to wait it out until it kind of comes back. So what I did instead of just selling everything off is I just lowered the percentage. So as you can see, only 10% of my income goes there. It's the lowest percentage, and I'm probably going to lower that even further and put more money up here into the indexes and to the dividends as these ones start to grow, and I want to get more money into those. So with M1 Finance, you can buy and sell, you can rebalance. Rebalancing is really good. So if one of these, for example, if one of these particular slices had a huge growth spurt and it ended up being a significantly larger percentage than I wanted, I can hit rebalance and it'll sell off the shares and then it'll redistribute those shares based on the percentages that I have here. So the bolded number, the 23, is the number that I've assigned of every dollar that I put into this pie. I want to have 23 cents go into this slice. 23 cents into this slice, 21 cents into this slice. You get the idea. Well, right now, of my whole overall portfolio, right, 23.2% is in that fund, which is great because that's about what I want it to be. This is a little bit high. This is a little bit low. This is a little bit low. And this one is right on 12% and 12%. And then as you can see, 9.7 and 10 is under what I want. So I might be switching this around. Then I love M1 Finance because it allows me the opportunity to come in here and edit it. I can edit how my pie works and I can change the percentages. I can add more to one slice than another. And then as I continue to invest every week, all that money will go towards the slice that is underperforming or under the allotment that I put it at. I really like M1 Finance for a lot of other benefits they have as well. Up here they have what's called the spend account, and the spend account is basically a checking account. This is an owner's rewards credit card. They have a credit card that gives you great cashback rewards, and then over here they have the M1 spend, which is their checking account. So they give 1.5%. If you're a plus member, an M1 spend plus member, which is an annual fee, does have an annual fee, you get a lot of perks. You get a better borrowing rate when you borrow up here. You get 5.75% interest rate, which was, when I first started, it was like 2 or 3%, but because the Fed raised the rates, now it's 5.7. The spend account, I get 1.5% interest on my checking account there. Then there's no annual fee for me on the credit card if I pay for the M1 Plus, M1 Spend Plus account. I think it's $120 a year for that account. So this is basically, I wanted to share with you, if you use the link in the description below, by the way, and you start an M1 Finance account, I think you get $50 for opening an account. So go ahead and check the link in the description below, open an M1 Finance account. This is a great way for you to start investing. I highly recommend that you start investing with a platform like M1 Finance because you get to have the ability to just pick a percentage. You can put 10% into this fund, 10% in that fund, you can put 100% into fund, or 50 and 50, or you can do all the allocations you want, and then you just put the money in there and it just does it for you. I love that automation. One of the most important things about becoming wealthy is automating the process to becoming wealthy. The more you have to think about it and you have to wonder, should I buy this one? Should I buy that one? How many shares should I buy? How much money should go here? Should go there? The more you have to do all that, the less likely you are to actually do it. So M1 Finance is one of those fantastic ways for you to set it and forget it. Just put it in there, pick good ones, and then review it every 3 or 4 months to make sure that you're on track and you're headed where you want to go. I hope you enjoyed this video. If you missed the last one that I produced about how much money I made on YouTube my first month and in the YouTube Partner Program, go ahead and watch that here. Go ahead and subscribe to the channel up here and check out this video up here that YouTube thinks you might like. Till the next one, have a great day and we'll see you then.